Hello, Smarties, and welcome to another episode of Smart Real Estate with Westcliff. I'm Addy Saeed, and with me is Kaz Jaffer. Today's episode is all about one of the most enticing aspects of high return investments.
Thanks, Addy. High return investments are those opportunities where, with the right strategy and execution, investors can earn significant profits. But as with anything in real estate, higher potential returns also comes with increased risks. So it's important to have a well thought out plan.
In this episode, we'll explore what makes an investment a high return opportunity, and we'll look at some real world examples of how investors successfully capitalize on such projects. We'll also discuss the strategies that can help you manage the risks involved. Kaz, what exactly qualifies as a high return investment? There are deals where investors expect significantly higher than average returns, often because they involve higher risk, shorter timeframes, or properties in rapidly appreciating markets. Examples can include flipping properties in gentrifying neighborhoods, acquiring distressed assets, or investing in up-and-coming areas before price rises.
One of the most common high return strategies is property flipping. This involves purchasing a property that needs renovation, making the necessary improvements, and selling it at a much higher price in a relatively short time period. Timing, location, and renovation costs all play critical roles in determining whether the flip will yield a high return.
Another example is buying properties in emerging markets, areas where new infrastructure, businesses, or cultural trends are driving up demand for housing or commercial spaces. Investors who get in early can benefit from rapid property appreciation as the area develops.
High return investments can also include commercial or multifamily properties where the investor sees an opportunity to increase rents through strategic upgrades or improved management. The key is to identifying the properties that are underperforming relative to their potential and knowing how to unlock this value.
Let's talk about an example. Picture a neighborhood that's been somewhat neglected over the years, but is now on the cusp of a major revitalization thanks to a new subway line extension. An investor sees this as an opportunity and purchases a rundown multi-unit building at a relatively low price.
The building is outdated and the rents are well below market. The investor decides to renovate the units, updating all the kitchens, the bathrooms, and common areas, while also improving energy efficiency, which lowers operating costs. Once the upgrades are completed, the investor can significantly raise rents and attract higher quality tenants.
Within a year, the value of the building has increased substantially, and the investor is enjoying a much higher rental income with the prospect of potential density increases in the future. By taking the risk to invest in a property in a transitioning neighborhood and making strategic improvements, the investor was able to achieve a high return on their investment.
However, it's important, Addy, to note that the kind of investment does come with risk. If the neighborhood hadn't developed as expected, or if the renovations had gone way over budget, the returns might not have been as impressive. That's why managing risks in high return investments is critical.
High return investments are all about identifying opportunities, managing risk, and executing effectively. If done right, these projects can offer significant financial rewards.
If you're interested in learning more about high return investment strategies or want advice on how to get started, please make sure to subscribe to our podcast and check out all of our past episodes at www.westcliffam.com/listen.
And if you're ready to explore high return opportunities, or if you have questions, feel free to reach out at 647-799-2264. We're here to help you with your real estate journey.
And Smarties, please remember, this podcast is for informational and entertainment purposes only and does not constitute financial advice. Always seek professional advice before making any investment decisions.